Good afternoon and welcome to the Tonya Escobel Real Estate Show. Tonya Escobel here every Saturday from noon to 1 with Cross Country Mortgage, helping families all across Tennessee, Alabama, and Florida achieve their home ownership dreams. And here we are with Kim Hollingshead, my co-host, Hollingshead and Associates. So excited to say it's just us today because normally we have these amazing guests on.
We do.
And, before the show, we're like, okay, it's just us today. And what are we going to focus on maybe behind the scenes of what a lot of people don't know that happens? Like we're juggling how many balls behind the scenes at all times. Yes. So we're going to be focusing today really on real estate, what's happening in the lending world. And then also Kim has got some expansion growth that's happening in Middle Tennessee. So we want to talk about that and just some of the things that you're doing to renovate, like instead of just normal title, and how you're making it easier for not only your clients as far as consumers closing, but also your real estate agents and your builders too. So so if you would like to get any information, maybe find out who's a great realtor to work with, a great builder to work with, you can always give our local team a call at 615-300-0794, 615-300-0794. And if this is your first time to ever tune in, you can also go watch some previous shows. It is on podcast, it's on YouTube, on social media channels. So come check us out and give us feedback, because we started this show to provide education around real estate. It's one of the biggest investments that you're going to make. And so here we are wanting to, add that value and to keep everyone educated. I mean, it's been, every market's different. We've talked about that. A year ago in January, we're at a totally different interest rate level. We hit a high in November, 40-year inflation high. But the good news is we're starting to see rates stabilize a little bit and even come down. And so if you're sitting on the fence, I think you should.
Now is a great time to buy.
Get your gears in charge and come and find out, because it is complimentary to find out what your purchasing power looks like, what your financial DNA looks like.
Yeah, because it's still, prices are going to continue to go up, right? We know this. Prices are going to continue to rise. And the reason is because we have a housing shortage. So regardless of what's going on with interest rates, there's just not a lot of inventory to sell. And we all know basic economics, right? So we know that when supply is down, the prices are going to be higher. So prices are going to continue to go up. And interest rates, we feel, are going to start to come down, especially in the back half of this year, right?
Yeah. And especially third and fourth quarter.
Yes.
And so a lot of, I've always worked with builders, actively involved in the Home Builders Association for many, many years. And, a lot of my new construction clients are like, should I lock in now and do a long-term lock? Because we can lock up to a year, but with the trends that we're looking at, 100% of my clients right now are saying, okay, let's watch the market. And so they're listening to the advice. We're, have our hands on the pulse. If we do see something happen that's beyond our control, at least they know they have the comfort level of being able to do a long-term lock.
Yeah, and that's so important that consumers really listen to their loan officer when it comes to, do I lock? Do I not lock? What's a good, right? Which loan program is going to be the best for me given the situation? Because there is no one size fits all, right? It's going to your specific situation, your buying power, the market, what you think as a loan officer is going to happen to rates over the next few months, and what kind of an opportunity a borrower may have to refinance, maybe, at a later time as well. So, I mean, all of that goes into play. It's so complicated. There's no way I'm in the business. There's no way I could never do my own loan. I could never choose my own loan.
Oh, it's so fun to do your own loan. And especially, it's like, should I lock today or should I float? Right. I totally get what you're saying, because it is challenging. And then just going through the emotions of, even though I'm in the business for 28 years, I mean, I still have to go through an underwriter. I still have to get the appraisal to make sure my collateral is good and it's going to appraise for what I'm paying for it. So it's a big choice for people to make. And I think that you're 100% correct when it comes to just everyone's, I get a lot of times oh, my neighbor got this, or my neighbor did XYZ, or my coworker did this. But everyone's financial DNA is so different. And that's why it's so important to do that complimentary consultation. I talked to a client earlier this week. It's his first home. He's never done it before. He's single. He's doing it on his own. And just, you could just hear the fear in his voice of how do I even begin this process? Like it was such a huge decision for him just to step up and say, I'm going to try. And that's what I encourage people to do that's listening. If you've not bought a home before, just try.
Just try it. And also, if you can buy a house, you can pretty much get a great rate on your car note or any other financial products that you may need. And your loan officer will actually help you clean up your credit too. Yes. Right. So this is a little hidden service that a lot of people may not know, is that your loan officer can actually, they can tell you how much to pay down or not pay down on certain credit cards, right? I mean, we may have the assumption this happens on occasion where a borrower may think, oh, I need to pay off all my credit cards and close all those accounts before I can buy a house.
That's not true.
That's not true. And it's not always the best thing to do for your credit score, right?
No, especially a lot of people think, okay, let me go and pay off my credit cards and close them. So closing your credit card actually impacts your credit score negatively.
Yeah.
Because it's taking away trades. And so 35% of your credit score is late payments, 30% is credit card revolving debt, but 25% is length and the trade history that you have. And so that's why you don't want to, yes, pay them off, but just don't close them. And then the one that everyone is most concerned about is the inquiry. And that's the smallest percentage, especially when it comes to a mortgage.
Yes.
So I get that a lot.
I don't want to apply for a mortgage because this is going to ding my credit, and then maybe I won't qualify for a loan, right?
Yes.
That's what they're thinking.
Yes.
And what you're saying is it's just negligible. There's really no impact.
It's the smallest percentage when it comes to a mortgage. So one of the things that I was talking to a client about, that they were really concerned about their credit being dinged. But then they wanted to know, what program do I qualify for? What's my interest rate going to be? How much do I have to put down? And really the number one thing that determines us to recommend a program is your credit score, and also your income and your assets, and verifying that information. So it is the very first step in going ahead and allowing a lender to be able to pull credit. And,
so important.
Yes, it is, to really know what you're looking at. And as far as you were talking about with the credit score, I use this example a lot, and I've done it for years on the show. It's almost like you get into your car in the old days and you didn't have GPS. So you're looking at a map, you're trying to figure it out, but you don't know if there's a detour, you don't know if there's an accident, you don't know if you should reroute, right?
Right.
Because you're just looking at a piece of paper. And that's the same that I feel like someone that's just looking on the internet, learning how to improve their credit scores. So once you apply with us, Fannie Mae and Freddie Mac, which we'll talk about this on the show, they actually have 8 different tiers when it comes to credit scores and rates right now. It was 6. May 1st, they rolled that out, but a lot of lenders have already incorporated that. And so when it's the number one thing that drives your credit, drives your tier, we have a program, I call it Credit Essentials, Credit Expert, and we actually go directly to the bureaus and ask the bureaus, what can we do for this consumer to get their scores up? And it actually will give you a report. It will give you a potential range that it will go to. So it's like the GPS to your credit. It's not like the old-fashioned way trying to figure out, oh, I think because I Googled this, if I do this, my credit score will go higher.
Sure, you're kind of guessing when you just Google it, right?
To where this tells you exactly. And sometimes it's the difference between, the biggest example I can give you is, so a lot of clients maybe use their business credit cards for points to travel, hotels, right? They pay them off every month, but they recharge them consistently.
Yeah.
Again, credit card revolving debt is 30% of your credit score. So if they never pay them off, they never feel that impact of their score getting better. So some of the easiest ways we've been able to move people in 2 to 3 tiers and get them a quarter to half a percent better in rate is just to pay off the credit score and do a rapid rescore, which through us takes 5 to 7 business days, not 30 to 60.
That's so interesting. See, I love that. And that's what I tell young people is I say, oh man, when you're young, you feel like you just don't have enough to qualify for calling a financial planner, right? Like when you're, you remember when you were in your 20s and early 30s, you're like, you just hardly had any cash in the bank, and you have maybe a little 401k, but by that point it hasn't grown significantly yet, right? And so what do you do, and who do you turn to for financial advice? And I tell young people, I'm like, hey, a loan officer is a great person to talk to for the basics, like basic credit score, basic how much money should you have saved in the bank, right? I mean, you can really help people with that.
Yeah. So if you're out there and you're thinking, oh, I just don't know if I could do it, I'm too scared. Don't be scared. We've all been there.
Yes.
And even though being in the business, as Kim mentioned earlier, we still, it's one of the biggest purchases you're going to make. So it's okay. We can help you as your local team. You can call us 615-300-0794. 300-0794. We got to take a break. We come back. We're going to dive into a little bit more about what's happening in the mortgage industry. There's some big changes this year. We'll probably see a switch of loan programs that are being offered, and also Kim's expansion. So stay tuned. You're listening to the Tonya Escobar Real Estate Show right here on Super Talk 99.7 WTN. Welcome back to the Tonya Escobar Real Estate Show. Tonya Escobar here every Saturday from noon to 1 with Cross Country Mortgage, and helping clients identify the best financial package for them. You want to find out your purchasing power? Give us a call, 615-300-0794, 300-0794. My co-host, Kim Hollingshead with Hollingshead & Associate, make sure that your title is protected when you do purchase that home. So I know we've had some stories about that before too. If you don't have the right title company to insure you, that could be a challenge as well. So you always have a right to your title company, and any information that you feel that we can either refer a realtor, a builder, or answer questions regarding title work or mortgage financing options, give us a call, 300-0794. All right, so Kim, we were talking a little bit about being nervous about buying our first home and being in the business. And not only our first, but even our second or our third or our fourth, just because it is, you're waiting for that underwriter that has all the power to say you're approved or not approved, which is underwriting basically according to FHA, Fannie, or Freddie guidelines. So the message was really just for you to know that it's okay to feel that anxiety a little bit, and just working with your local team. The first step, it doesn't cost you anything, is really just stepping forward and saying, hey, I think I want to buy this house. I am tired of renting. I want to build some wealth. We had a guest on previously. I think they bought their first home, $130,000, kept it for 2 years, and sold it for $160,000. And this was years ago. And obviously we know what appreciation has been doing in Nashville. We're in a really good area. And I say Nashville, but really Middle Tennessee.
Yes.
So it's just a good time to step into home ownership, find out what those options look like. And I always tell everyone, it doesn't cost you anything but your time. Literally, that's all it costs, because there's, when you go to a stock planner or you talk to your tax person, a lot of times they're going to charge you per hour on giving you advice. Loan officers don't. We don't.
That's right.
You're a doctor, you go to a doctor, they're going to charge you for that visit, right?
Exactly.
But loan officers, we don't. And that's what we're here for, is to help you identify your best options.
And the cool thing about living in the U.S. is that, home ownership, obviously, is such an important right for Americans. And we make home ownership very accessible. And so a lot of times we're a little more pessimistic in our own minds and in our hearts about what we're able to do than what is really possible, right? And I'm sure you see this, how surprised people are to know that, oh, I didn't know I could qualify for that much, or I didn't know I could get a rate that low. And really, that pessimism is natural. It's normal. It's okay to feel that way. It affects the people's, I guess, their interpretation of how much down payment they will need. We know that millennials and zennials tend to be more pessimistic about thinking that they all have to have 20% down, which is not true. You don't. But it's really that knowledge is power, giving yourself that certainty. And like you said earlier, a roadmap to home ownership.
Yeah.
Right? I mean, you're just going to tell them exactly what to pay, how much to save, how long it's going to take them to get there. And when you have that plan in mind, it's easier for you to reach that goal.
Yeah. And I think it's easier for them because it removes that little bit of fear.
Yes.
Because so many people sit on the sidelines and like, I just don't think I can buy. I don't know if my credit's good enough. I've got to pay this credit card off. I've got to save another $10,000 or $20,000 to be able to come up with a better down payment. But what a lot of clients don't realize is that first step in identifying what your financial power looks like as far as buying power, $10,000 extra in savings is usually $30 a month in payments. And so it's not as impactful as what they think it is. And by the time that they wait to save that, did the home price go up a little bit more? Did interest rates change? So the things that affect your purchasing power is interest rates and appreciation. And so that's where I just encourage people to step forward and do an application, go through the process. It's not hard. It's 10 to 15 minutes, maybe over the phone initial conversation. You go online, you set up a secure account. There's so much with technology now. It's not like it used to be where you're running around getting a bunch of paper. You can upload it into the portal and you'll know within 24 hours if you're pre-approved. A lot of people think it takes longer than that, but it doesn't. It does not take that long to find out.
And now, then you can go shopping.
Yes. And then it's like you have a credit card to go find a house.
That's right.
And we identify, a lot of times we'll identify what is the highest credit limit that you can qualify for. But maybe that client just wants a payment of XYZ. And so that sales price is maybe $500, even though they qualify for $750. And so at least you have that discovery to know what that looks like, and you feel a little bit more confident.
Exactly.
You don't want to go into the mall when you know your credit card's maxed out and you can't buy anything. It's just so tempting.
True. And Googling for information is so unreliable because everything changes so rapidly in mortgages.
Yes.
I mean, all the time. The programs are changing. The interest rates are changing. Your payment is going to fluctuate month after month after month. If you're just Googling it online, there's no way for you to calculate it. You've got to talk to a loan officer.
Yes, 100%. And then what we're seeing in this market, that I'm just so proud of our builders that continue to build new construction for families and helping them, get something new in the American dream. Some of the builders that I've worked with, we've come together and we said, okay, rates have risen from where they were a year ago in January. Yes, we are much better than where we were fourth quarter of last year. But they're still a little bit higher. And so there's a little bit of sticker shock from affordability with some of the sales prices, because sales prices are continuing to rise, even though interest rates are rising. So the perception is, I can purchase this home. And because they were looking online maybe a year ago, they were seeing totally different payment amounts. And so those payments, I tell a lot of clients, I'm like, you can Google mortgage rates today. It's going to show you, when I looked at it on Friday, it's going to show you 6.5% to 7%. That is the average rates that are in the nation right now. Now, where you see lower rates and lower rate quotes is because they're adding in discount points, which is something that our industry has not done in over 20 years.
Right.
No one really paid discount points because it was only changing their rate by 0.25%. So what we did is we got together with some builders that I work with, that I've known for years, and said, okay, you've got some inventory. You want to move your inventory. You've got consumers that are scared about a 6.5% rate. So we put together Cross Country Mortgage and these builders. We got together, and we're actually on some programs, depending on obviously the credit score and what they qualify for, offering as low as 4.75% on a 30-year fixed. And the buyer is not paying that rate buy down. So instead of them going to a resale home and looking at maybe a 6.5% rate, our new construction builders that we're working with, that we've partnered with, are actually giving those incentives at 4.75%.
And they get a new house.
And a brand new home.
I mean, that is really nice to
So that's what I love about our builders, are always thinking of, okay, we've had a shift in the market. We've got homes that are ready to be delivered. Because, you went through a stage where people didn't want new construction because they didn't want to wait. So they were buying more resale, and they were actually paying so much more over asking price, list price, just to get moved in, because there were so many multiple bids. So if you're out there and you've thought about, hey, I do want to buy a home, maybe new construction is a time, looking at new construction, it's a great time, because you're getting incentives that you were not getting at least a year ago, and interest rates. So, I was talking to someone, and they were looking at a home, and it was $100,000 more, and it was a resale home. And they looked at a new construction, and they were like, I just don't think I can afford that because it's $100,000 more than my resale, right? So there was a difference, $100,000. But with the new construction, because of the interest rate difference, it was pretty much equal to the same payment, and it was a new home. So that is where I always encourage people to call, have a discovery call, find out what your purchasing power looks like, what is your goals as far as monthly payment, cash out of pocket, and maybe it is a resale home. That's great. But maybe it's a new construction home because it could be $100,000 less than that resale. And even with the rates as low as what some of these builders are offering, is really saving you a lot of money.
Yeah, because everybody lives in a monthly payment. People don't live in an interest rate.
Right.
So, you know, when we're looking at interest rates to give us a guidance of what we think that monthly payment is going to be, but there are so many factors, like HOA dues can greatly affect your quote monthly payment, right?
Yes.
And so it really depends on what neighborhood you're in. And then, like you said, hey, there are ways that you can discount an interest rate to help someone get in at that lower. And you said a fixed rate for
that was 30-year fixed.
30-year fixed.
4.75, yes.
Wow.
So we have Region Homes is running that promotion in one of their communities. And so if anyone is interested into that, they have single-family homes and townhomes. Single-family homes, there are 5 left right now. Townhomes, there's only 6 left. So if you would like to get some information, give us a call. This is owner-occupied. It's not investment, so it's for owner-occupied consumers. 615-300-0794, 615-300-0794. And Regent is just one of the building partners that we're working with.
Yes.
Also, Vaslin is doing the same thing. They're putting a lot of money toward to get a low-rate buy-down.
Nice.
Brightland Homes is doing it. So there's several builders that we're working with in Middle Tennessee. And what you normally see from the loan officer side, competitor-wise, is they're doing ARMs, or they're doing the 3-2-1 buy down, where your rate is this the first year, then it moves up the second year and the third year. This is fixed for 30 years, so you don't have to worry about stepping into a higher payment year 2, year 3, year 4, or being into an ARM. It's
right.
fixed
You don't
for
have
30
that
years.
pressure to refinance later when you feel like rates are going
Or that uncertainty of where the market's going to go. Or,
right.
yes, I can afford this mortgage payment today because it might be at 2.99%, but next year it'll go to 3.99. Next year it'll go to 4.99, 5.99.
Right.
So you're stepping into a higher payment. And for some people, that's great. And the clients that I feel that that's great for is if they're only going to be in the home for a couple of years. But when you're looking at a new construction home and your builder's basically buying it down into the upper 4s, that is the most secure, most conservative thing to do.
Wow, that is so smart, Tonya.
All right, so we got to take a break. When we come back, I want to dive in just a little bit about Fannie Mae, Freddie Mac, and FHA loans and the changes that's happening. And then we've got to hear all about your new office because I'm so excited about it. Yes, so stay tuned. You're listening to the Tonya Escobel Real Estate Show right here on Super Talk 99.7 WTN. Welcome back to the Tonya Escobel Real Estate Show. Tonya Escobel here every Saturday from noon to 1 with my co-host Kim Hollingshead with Hollingshead & Associate, real estate attorney. And we have just really been talking today. It's just me and her. We don't have a special guest. We just wanted to kind of break down some of the basics that's happening in the mortgage industry and also some things that are happening with her firm and expansion. So if you're just now tuning in, you can always catch us on social media, also on YouTube, podcast, Spotify, and other different platforms to listen to previous shows. And also if you're just now tuning into this one. So we're really focusing in on, there's a lot of lending changes. So I wanted to take the time with Kim to really dive into that and let our listeners know. A lot of companies have already switched to this. Fannie Mae and Freddie Mac basically changed their guidelines when it comes to loan level pricing is basically what we call it. And so regardless of what the bond market is doing, Fannie and Freddie do risk-based pricing. So they're like, in the past, they had 6 different tiers for credit score. 740 was the highest one. Every 20 points moved you to a different one. Their minimum score for lending was 620. So anywhere from 620 to 740 were your tiers every 20 points, right? So now they've moved those tiers higher. It's still every 20 points, but they have a tier for 760 credit score and a 780 credit score. Now, what is interesting, what Fannie and Freddie did, and as an industry, we're looking at it because this is not cross country, this is across the board. Anyone that does conventional lending with Fannie Mae and Freddie Mac are subject to these price changes that will go into effect of any loans that are securitized May 1st. So that's why I said a lot of our competition has already done that. Cross country actually gave a grace period. If as long as you funded by April the 15th, we would give you the old loan level pricing adjustments.
Nice.
And that was almost 3/8% difference in rate. So what is kind of like, we look at this and we're like, oh, so consumers in their mind think if I've got an excellent credit score and I'm putting 20% down, I'm going to get a really good rate, right?
Right.
Well, the way that they did their risk-based pricing, it's almost more attractive for someone doing a minimum down payment and getting a better rate with a higher credit score than someone putting down 20%. And where you start to see a bigger break in the score is when they're almost putting 40% down. So it's really interesting that the middle clientele that are putting money down are subject to higher rates with this new pricing adjustment. So I don't know if it's gearing toward, maybe more first-time home buyers as far as a minimum down payment. But, I mean, usually from common sense standpoint, if you're putting more money down, you should get a better rate. So that is something we'll have to navigate through, which we've been doing it for the last 30 days because they announced it, I believe it was end of February, 1st of March when they announced it. And like I said, we have been quoting old pricing versus new pricing, and I'm seeing anywhere from 1/4 to 0.5% difference in rate, regardless of what the bond market is doing.
That's interesting. So when you say a minimum down payment, right? So what does that mean?
So unconventional 3% is their minimum down for first-time home buyers. A lot of consumers will move into 5% just because it will help their interest rate a little bit and also the mortgage insurance that they have.
You're right.
But it is a minimum of 3% for first-time home buyers.
That's pretty good. So it helps increase your buying power in this market where the prices are continuing to go up, right?
Yes. And you're getting a better rate to where it used to minimum down was a little bit of a higher rate. And if you put 20% down, so, we always talk about busting myths.
Yes.
So the old myth has been, if I put 20% down and I have a great credit score, I'm going to get the best rate. That's not true with Fannie and Freddie, the way that they're looking at loans. Now that is just Fannie and Freddie, which their conforming limits, we were talking about this, their conforming limits is 726,200. The good thing with the surrounding area of Middle Tennessee is we have another level that's called high balance, and because we're a high cost area is what they look at. Our home prices are high. So Fannie Mae, Freddie Mac, and FHA will say if you're in Davidson County, Rutherford, Wilson, Sumner, I'm trying to think of all the different counties, but it's the surrounding of Middle Tennessee, Davidson. You can get a loan all the way up, a loan amount up to $890,100. And you can still put 3 to 3.5% down, maybe 5% on the conventional side, but 3.5 to 5% down. Yes. So used to it was always a jumbo, which a jumbo moves you to a 20% down payment.
Right.
So we've been able to help a lot more families this year that fall in that high balance market with less money down.
Because, I have a lot of friends. Well, I live in the Gulch. You live in Edge Hill, which we know you are running for city council of your district. We're very,
District
very
17.
excited. I'm so proud of you. And I'm your neighbor in the Gulch. And we know a lot of people who love to live in the city, but they rent, right? And I think a lot of my friends anyways, they rent because they have it in their mind that they have to put down 20%. No matter what, it's 20%. And I was even surprised to learn today that I could put down 3% to buy something with a loan amount of, what was it again? Over $800,000.
$890,100. That is the loan amount. So even if you have someone that's buying $1 million home but doesn't have 20% to put down, they can just do that difference and finance $890,100 and get FHA and conventional rates.
Wow. And so you can still stay in the neighborhoods that you love, have the amenities in the home that you love, and not have this massive down payment stripping you of all of your cash savings, right?
Yes.
Because as you know, we all live in monthly payments.
We do.
We say this all the time.
Yeah.
And so it does help if you come from, somebody who's renting downtown or, or maybe you do own a home and you do want to buy something and upgrade a little bit. It's nice to know that you have that buying power to support you to do it.
And that is what a lot of consumers don't understand. So So you have conforming, which means that's Fannie Mae, Freddie Mac rates, right? They're 726,200. That's going to be the most aggressive rate you can get. If you're in one of these surrounding counties that I just mentioned, Davidson, Rutherford, Williamson, Sumner, then those counties will allow you to go up to the 890,100, but your rate will be different. And so usually what we see, depending again on your credit score, you're going to see anywhere from a quarter to maybe a full 5/8% higher in rate, because it's considered what we call in our industry a high balance, because it's not the national conforming limit. It's above that just because of the county and the area that we're in. But it's still, like you mentioned, is a great opportunity to be able to buy at that price point, to where in the past it was a jumbo at 20% down, right?
Right.
To where here you can, do 3.5% FHA, 5% conventional.
And that's doable.
Yes.
That's totally doable for a lot of people. And didn't FHA raise their loan limits recently as well?
So what FHA did, they are in line with these loan limits, but what FHA did was they went in and lowered their mortgage insurance, their monthly mortgage insurance.
Oh, nice.
And across the board, the way that Ginnie Mae bonds are trending are actually averaging lower than conventional. So for years in the industry, FHA was always a lower interest rate, right, than conventional. Then the last 4+ years, we switched to more conventional lending than I've probably done. I used to be pretty, 50-50, but then it increased to about 90% being conventional. And the reason is because their rates actually started trending lower than FHA. The mortgage insurance on the private sector, if you had really good credit scores, were less. So Fannie and Freddie conventional loans come out and actually raised their loan level pricing to where FHA said, okay, we're going to keep our rates lower and we're going to lower the monthly mortgage insurance. So
to make it even more affordable for families.
Yes. So someone that used to would do a 5% down conventional.
Yes.
If you do a 5% down FHA, you're going to save money, because the rate's lower and the mortgage insurance is lower based upon what they just did.
And the loan limits are right in line with conventional loan limits as well.
Yes, they're
because
exactly
that's the other
same.
Misconception is that FHA you have to buy a lower priced home.
That is a big misconception. And a lot of people think, well, I don't want FHA. Why do you not want FHA? It's for low income. No, I mean, it's $890,100. Yeah. That's not low income. My very first loan was an FHA loan. So it's a really good loan. I think people have it's one of those myths, like you got to put 20% to buy a house. That it's just a myth that people think that FHA is not attractive, and it means you're getting into some government loan. It is insured and backed by the government, but it's not a down payment assistance or anything like that. So it's a great loan, and rates are lower now, and the mortgage insurance is lower, and that is basically what I'm seeing. We're going to see a lot more FHA loans in the market versus conventional, because conventional just raised their rates and loan level pricing adjustments, to where FHA did the opposite.
Well, they're just buying a home here in Middle Tennessee, where prices are continuing to go up. It's becoming more and more accessible, and it changes constantly. Yes. Which is the reason why you got to call your loan officer, right?
Yes.
Just get the ball rolling.
And that's 100% true, because you're not going to be able to Google all that.
No,
it's not going to happen. And then you're going to get so much confused. You're going to get so confused with so much information that's out there.
So true.
Yeah. So give our local team a call, 615-300-0794, 300-0794. We're going to take a break. When we come back, I want to hear all about your new office and things that Hollingshead and Associates doing right here on the Tonya Escabel Real Estate Show. All right, welcome back to the Tonya Escabel Real Estate Show. Behind the scenes, we're having a lot of fun today. I hope we're providing a lot of great education for you. If you'd like to find out your purchasing power, give us a call, 615-300-0794, 300-0794. In studio with me is Kim Hollingshead with Hollingshead and Associate, and we're just having a great time helping clients achieve wealth through home ownership and real estate, and then just... just behind the scenes kind of fun before we came back on the air and talking about, really we were talking about future shows and wanting to do a different format and the RAS maybe. We don't know. And I would love for a listener to text me if they know what the RAS means.
Yes.
We'd be happy to give you a gift card to Home Depot, $50 if you know what the RAS means. 615-300-0794, 615-300-0794. So the roundtable RAS, I don't know. We're coming up with it, but all right. So back to our show and being focused, you have an amazing opportunity with the new office that you're doing. So tell our listeners a little bit about what you're seeing on the title side, since we've been really talking a lot about mortgages.
Yeah. So I'm so excited. We are moving to an office on West End. It's going to have the conference room is going to have a beautiful view of downtown and West End Avenue. It's all glass, very high end, very modern feel. But of course, we're always welcoming for all of our guests, right? But we just want every closing to be an experience and to feel super special. Yes. So that's why we're moving there. Of course, the building is the Vastland building, and your listeners may be familiar with Parlor Donuts. That's on the first floor, which, as you guys know, that's my favorite food. So I knew that's where I belonged. I was like, oh no, they have a Parlor Donuts. This is a place for me.
That's where your coffee meetings are going to be, lunch meetings.
That's right. So anyway, so we're super excited about it. And I do have a title update for everyone too.
Okay.
So the Tennessee Land Title Association is an offshoot of the American Land Title Association. Of course, they represent Tennesseans, and I'm a proud member. And have been for many years. And they kind of do some work behind the scenes. So people are always asking me, oh, do I need title insurance? And what are you title nerds doing out there? What do you know? Because we're a special breed, right? Kind of like locked in rooms and researching titles. And well, some of the things that we're doing is we're protecting consumers sort of all the time, a constant just barrage of things like online wire fraud or hacking. We're educating consumers about banking protocols, procedures, how to protect their money, and then also actually protecting consumers on the title side. There was a real estate brokerage that in another state started this trend of lending a buyer of a home a little bit of money. Maybe it's $5,000 or $10,000. And in exchange, that buyer would give that real estate company a 40-year-long listing agreement that said, you're obligated, no matter who buys this house or who owns the house for the next 40 years, they have to use this real estate company, this realtor, and they have to pay a full 3% for the listing. And because this agreement was recorded in the records office, then it created a cloud on title, and it made companies question whether it was enforceable or not, right? And of course, that whenever you exchange money for a property, right, oftentimes that's interpreted as a mortgage, and there are certain rights and obligations that are associated with a mortgage. So it just created all kinds of problems. It also sort of took advantage of some people that would take a $5,000 or $10,000 payment, right, at the time that they're buying the home. So the AARP was fully supportive of Alta and the Tennessee Land Title, and they ended up convincing the state legislature here in Tennessee to pass a law to prohibit those types of agreements. So this is something that hasn't really come to Tennessee. Only a few of these contracts had been recorded in the state, but they kind of headed off that threat at the pass, right?
Yes. So that way it can't be abused going forward.
Right.
So I had never even heard of that before.
Right. Can you believe that they were trying to, and up north in the northern states, it was a much bigger problem and had been kind of this ongoing issue for a while. And so here in Tennessee, us title nerds got together, and the title nerds were like, nope, not in our state.
Yes.
Right? We're protecting our home buyers here in this state. So that's kind of the work that we do a little bit behind the scenes that consumers may not be aware of.
Yeah. I always get asked this question, and, I do all the numbers and the loans and the guidelines. And so I never sometimes know, I know based upon like being protected from title insurance, what that looks like. So when a client says, why do I need to pay for this policy? Because, looking at closing cost outside of discount points, it's a pretty high cost.
Yes.
And
yeah, I agree.
So when they say, why do I need to pay for this policy? And there's always a question between lenders and owner's policy. Can you kind of explain that to listeners?
So I agree that it can be costly, right? It is unlike homeowners insurance, you only pay it one time at the time that you purchase a home. Obviously, when you purchase in Davidson County and some of the surrounding counties, it's more customary for a seller to pay for that policy than for a buyer, but the buyer on a refinance will always pay for it, right? So the bank always wants to make sure that they have that title insurance protection, that their lien is guaranteed to be in first position or, in second position, but they at least want a title opinion. And the reason is because they know firsthand how many defects on title, how many clouds on title there can be. As a consumer, you really have no way of knowing if title to that property is free and clear. It doesn't matter how long a particular homeowner has owned that property. Of course, the risk goes down over time. Let's say you've had somebody living in the house for 50 years, they've never had a title claim, but if this is the first time that title is being examined in 50 years, you don't know what you're going to find. But ultimately, as a consumer, you don't know if all the people who have a property interest are signing the deed to make sure that you're receiving full, clear, and free and clear title from everybody who has an interest in property. And then also any kind of encumbrances. Oftentimes your title attorney is checking the legal description and making sure that your legal is good. If they don't like it, they may ask for a survey, at least a boundary line survey to remove or to give you any kind of survey coverage, but also pulling restrictive covenants. And sometimes they're gonna find property rights that are buried in a deed from way back when. And as a consumer, you're not reading that deed. Yeah. You do need an expert. You really do need to have a real estate attorney and a title expert examine the title before you purchase this home. Very rarely is there ever a total failure of title. Oftentimes it's things like unpaid taxes or a mortgage or some kind of an outstanding judgment or an outstanding lien against a prior owner. But how annoying would it be to purchase a home and then, a couple months later you discover, oh, there was a homeowners association lien for unpaid dues that now I'm responsible for. Well, if you purchase, and how would you know that as a consumer? How would you know? Because you're not going down to the courthouse and searching the records yourself, right? You've got to have that title examination by a professional to tell you the state of title. And then also the insurance is that indemnification. Because guess what? There are some defects of title we can't discover in a search. So I can't tell you if a deed was forged in the chain of title or if an heir is missing in the chain of title going back, but I'll still indemnify you against that loss should a claim arise. So it's important.
And I've used title insurance because there was, like what you're talking about, things that had come up on a purchase that I had no idea as a buyer,
Yeah, how would you know?
And it protected us. We were able to get protection. So I would love to keep talking about this. I know we're running out of time, but also for our next show is to talk about, because I came from Texas, so you actually had to be a real estate attorney before you could offer title services, to where Tennessee is not attorney state.
Nope.
So I'm curious if there might be some movement going in that direction, because it's important, like you just said, to have a real estate attorney and be able to run that title company and to make sure that they're looking at everything the way that it should be and training their staff to look at everything that it needs to be. Yeah. So anyway, that's for our next show. So anyway, you're listening to the Tonya Escobar Real Estate Show. Kim Hollingshead, Hollingshead & Associate, my co-host. You can always give us a call, 615-300-0794. You can find us on social media, YouTube, podcast. If you'd like to jump in and hear some of our previous shows that we've had, we'd love for you to follow us. So have a blessed week and be sure and tune in next week to the Tonya Escobar Real Estate Show from noon to 1.